Good morning, students. My name is Kathryn Main, and I am the founder of Money Savvy Humans. I teach kids, teens, and adults how to make and manage money. This very impressive CV that you see on your screen here is not the girl that I was. In fact, I was a high school dropout and at 30 was completely bankrupt. After being bankrupt, I decided to financially educate myself, and 4 years later, I was making 6 million Rand a year. I took everything that I learned around going from zero to hero, and I put it into a program called Money Savvy, and I now work with kids, teens, adults, and corporates to make and manage money. Today, we are going to talk about interest and compound interest. But before we get to compound interest, let's talk about what is saving and why do we save. In South Africa, we live in a buy now, pay later society. We have a very low saving culture in this country. We are not trained in our education to plan ahead. So we're not taught to think about what does our life look like in 20 years from now? What does our retirement life look like? So we have a very, very low saving culture. So what is saving? Saving is the money that we put away for future use. So why do we save? There's a couple of reasons that we save. We save for emergencies, we save for goals, and we save for retirement. So saving for an emergency. We've all just experienced the first global epidemic of our time. And a lot of people who didn't have savings in the bank, who did lose their jobs, had a very good chance of also losing their homes, their cars, and other assets that they might have had because they didn't have an emergency savings account. If you have an emergency savings account, it gives you a little bit of runway so that if any financial tragedy does happen, that you've got some savings in the bank to help get you through. Saving for a goal. Why do we save for goals? So we all have different values, different belief systems, and come from different backgrounds, and we all want different things. And goal setting is one of those things that really, really changed my financial behavior, because once I had achieved one small goal, it was much easier to achieve much bigger goals. My biggest goal is actually saving for retirement, and I plan to retire in 7 years at the age of 51 with 100 million Rand. And that retirement saving has been going on for 8 years already. So I want to encourage you guys from the day that you start working, that you already start planning to save for your retirement. When we save, we're saying that we are paying ourselves first. We are putting money away for our futures and for the important things in our life, and just in case we might need it. If we do not prioritize saving and we prioritize spending over saving, essentially what we're saying to ourselves is that we are not important, that our own personal financial security is not that important to us. So when you start earning an income, I would like to encourage you to start paying yourself first from the very first paycheck that you have. Because if you can start paying yourself first from your very first paycheck, you are really going to benefit from compound interest. So what is interest? Essentially, interest is the cost of money. So whether you are borrowing money from a bank or whether you are saving money in the bank, interest is the cost of money. So if you put money into a bank, the bank will pay you for saving there. But if you borrow money from the bank is going to charge you for lending you that money. So interest is essentially the cost of money. Compound interest means you are getting charged interest on top of interest. So when you take out a loan, your compound interest on debt is generally calculated daily, weekly, monthly, depending on the institution and how much money you borrowed. But when you are working with compound interest with regards to saving, you're probably going to earn annual interest, if you're lucky, monthly interest. So interest is the cost of money. So what is compound interest? Compound interest is sometimes described as the eighth wonder of the world. And why do we say that? And it's because it creates a snowball effect for your finances. The power of compounding means that if I save 1,000 Rand in year one and the interest rate is 10%, at the end of year one, I've got 1,100 Rand. And then on the second year, they pay me on the 1,100 Rand and not just on the 1,000. So the benefit of compound interest is you're earning interest on top of your interest. So to work compound interest, you need to have money, earnings, and leave it for a long period of time. So here's an example of a savings account and how compound interest can really benefit over time. So if you look at this example, Sipho, Yonela, and Matt each started saving 100 Rand a month. Sipho was 15 when he started. Yonela was 20 when she started, and Matt was 25. There was an interest rate of 6.5%, which is pretty low, especially for long-term savings. But if you actually look at the bottom amounts at the value of 60, you can see the difference between Sipho and Matt is close to R500,000. And that's the benefit of 10 years of saving. So if you want to get the benefit of compound interest, it's something that you have to do over time. So when you want to grow your wealth, growing wealth doesn't happen over time. If you get convinced that there's some kind of get rich quick scheme and it sounds too good to be true, it probably is. So be like Sipho and start saving from as young as possible. I have a business partner who retired at 40 because she saved 50% of her salary from the day that she started working when she was 15 years old and didn't have children and was very smart with her money. Here is another interest example calculated in a month. So working on if you had saved 10,000 Rand into a bank account and you had a 10% interest, you would over a 12-month period make that 47 Rand 13 cents. So what are our options when it comes to creating compound interest for ourselves? So we really essentially have two options. We can save or we can invest. So when we look at saving, what are our options with regards to saving? So everybody always says to me, what is the best bank account to save? How do I know which bank account is going to give me the best interest rate? So depending on the kind of time that you want to leave the money in the account and why you are saving will determine which bank account you are going to choose. So if you are wanting to save for a goal for a short time in under 5 years, a flexi fixed account or a 32-day call account is probably more appropriate because you might need access to that money at some point. For those kind of accounts, you'll get between 4 and 6% interest. But if you want to save over a longer term, let's say, for example, you'd already saved 100,000 Rand and you wanted to put that 100,000 Rand into an interest-bearing bank account, you would probably get between 10 and I see even African banks offering 12.5% interest, but you need to leave that money there for a minimum of 10 years and not be able to draw that money out. So when it comes to saving options, you can either save your money at home under your mattress or in a piggy bank. The problem with that is it's not safe. There could be a fire, there could be theft, and your money will not grow. You could open a bank account with interest. What do we need to know about interest? Is what is the interest rate? What is the cost of the bank account? Is the interest daily, weekly, monthly, or annually? You could also look at saving in a stokvel environment. So stokvels are incredibly popular on the African continent, and stokvels can yield high dividends and rewards depending on how many people are actually contributing to the stokvel. But the disadvantage is that the money isn't always available when you need it. In South Africa, we're very lucky that we get the benefit of tax-free savings accounts. So SARS allows us to save up to R500,000 in our lifetime tax-free. So you're allowed to save 36,600 a month, a year in a tax-free savings account for up to 5 years in a row. If you work out 36,600 times 5 and you put that money into an interest-bearing bank account, you will very quickly see that money grow. With that large lump sum of money, if you invested it into an income-generating asset, you would also then be able to make a constant income for yourself. Another way to benefit from compound interest would be to do investing. So what is investing? So investing is investing our money in an income generating asset in the hopes that that money will grow over time. So what is the difference between saving and investing? Well, saving is a little bit safer than investing because we put our money in a bank account and we wait for it to grow, whereas investing is we're putting money into an income generation in the hope that it will grow over time. So generally, if you want to decide whether you're a saver or an investor, it really comes down to what we call your risk profile. So are you a high-risk individual, or are you rather more moderate when it comes to taking risks? So if you're a high-risk, high-reward individual, you're more likely to invest money in high-risk, high-return investment options. So let me take you through some of the investing options that are available to you, so you can make a qualified decision whether you want to be a saver or an investor and benefit from compound interest. So we can buy shares. So essentially, what is a share? A share means that you are buying a portion of a company. So let's say, for example, you are a huge fan of iPhone, or you only wear Nike trainers. You could actually go and buy shares in Nike or iPhones. So you can get a broker, or you can do it online through platforms like Easy Equities or Satrix. There's lots of avenues available to buy shares. The benefit is that you get dividends and capital gain, and the disadvantage is that you could lose all of your money. You could also invest in property. Rental income also becomes a passive income stream. And if you started to save that money into an interest-bearing bank account and you did it for 10 years, you would get the benefit of compound interest. You could also invest in unit trusts. So unit trusts are pretty similar to shares. The difference between a unit trust and a share: so firstly, unit trusts are a little bit more expensive because they are managed by portfolio managers. We have very clever people sitting in offices looking and buying portions of shares in multiple companies. The benefit of buying a portion of a share means that if the share price goes down, you don't lose the value of the whole share, just a portion of the share. But if it goes up, you also then only get the value of the portion of a share. This is a lot safer for a lot of more moderate or conservative investors because it diversifies your risk and it stops you from putting all of your eggs in one basket. It really helps you to spread the money around and make sure that if there is a loss, that it's not such a large loss for you. Exchange traded funds or ETFs. So similarly to unit trust, you're not buying one specific product, but you're buying a basket of goods. So a basket of goods for ETFs will generally not just be shares, but it will be some cash, some gold, some oil, some businesses, some foreign currencies. It could be made up of bonds and shares as well. So ETFs are really a really nice way of diversifying your risk by investing in a basket of different assets. So you're not putting all of your eggs into one basket, only buying shares, but you're really diversifying your risk and investing in some property, some cash, some shares, some commodities. Government bonds. Government bonds is essentially debt. So you would buy a government bond from your government, and these normally yield around 6% interest. Commodities, so gold, silver, and oil. So you can buy gold and silver and oil, or you can trade gold, silver, and oil. Commodities is always something to add to your investment portfolio, because if fiat currency ever stops running, you'll be able to trade with gold and silver to actually barter for food and services. Cryptocurrency. So cryptocurrency is quite popular at the moment, especially among the youth market. I've seen a lot of kids trying to get into cryptocurrency mining and forex trading and those kind of things. So just a word of caution here, guys. If it sounds too good to be true, it probably is. There's a lot of fraud happening in the space at the moment with regards to cryptocurrency. So if you're going to get into cryptocurrency, make sure you understand what you're doing and do your research about what you're investing in. Are you doing mining? Are you investing in coins? How are you doing this? The benefit of cryptocurrency is the blockchain. The blockchain makes it quite difficult to hack. So if you borrowed money from an institution like a bank, the only person who knows about that transaction would be you and the bank. But if you did a cryptocurrency transaction, it would be slightly different, because everybody on the blockchain then has access to see that that transaction actually did happen. So the benefit of cryptocurrency is obviously the blockchain. It's still fairly unregulated. in South Africa, and if you do start trading in cryptocurrency, you will have to pay capital gains tax. So since planning for retirement is something that doesn't really happen, I would like to challenge you guys to work out how much money you need to retire. This will be a really, really fun exercise to do at home with your parents as well, so they know how much money they need to retire. So this retirement calculation is really to figure out how much money do you need when you stop working. So retirement age in South Africa is normally between 60 and 65. So if your parents are close to 60 or 65, do they have enough money to retire? If they had been saving and investing from the time that they started working, they would have been able to retire because they would have saved enough money to be able to do that. So I'd really like you guys to do this calculation. And what I want you to do is I want you to figure out, how old do you want to be when you retire? So 60 is a good age to retire. Me, I'm going to retire at 51 because that's when my kids are grown up. But what age do you want to retire? So if you work out, if you retire at 60 and you think you're going to live till 90, then you need to make sure that you have enough money to live for 30 years. So what is your monthly figure? Do you need 50,000 Rand a month to live? Do you need 100,000 Rand a month to live? So you would need to work out, if you had to live for 30 years, and your figure was 50,000, you'd work out 50,000 times 12, because there's 12 months in a year, times 30 years will give you your retirement figure. That will tell you how much money you need to retire. Then you need to ask yourself, okay, well, how many paychecks do I have left until retirement? So if you're 15 and you only plan to retire at 65, you still have quite a lot of time and quite a lot of paychecks. But if it's your parents and they're 50 and they want to retire at 60, they only have 10 years left. So they would be 10 times 12, and that would be able to tell them how many paychecks they have left until they retire. You can then take the amount of money that you need to save and divide it by your paychecks, and that will give you an idea of how much money you should be saving every month. This is obviously not taking into account things like inflation, but doing this retirement calculation will make you realize how important it is to start saving from the day you start making money. If you want to get the benefit of compound interest, if you want to grow your money over time, if you want to retire rich, you have to start saving today. Because if you don't start saving today, the benefit of compound interest gets lost. You saw the example earlier, SIPO versus MAT. 10 years was 500,000 Rand, and that was at 100 Rand a month. Can you imagine if you were saving 50% of everything that you earned from day one? By the time you were 50 years old, there's a very good chance that you would be able to retire. So that is the end of my presentation today around compound interest and the benefit of compound interest. I really hope I've given you some insights into why it's so important to save, and I would like you to start thinking about what kind of retirement you guys would like to have so that you know how much money you're going to need to retire. Thank you so much. My name is Kathryn Main, and you can visit us at moneysavvyhumans.co.za.